Welcome to Financial Analysis of POS Malaysia SDN BHD.
POS Malaysia BHD is a Malaysia-based company engaged in providing postal and business solutions. It performs its operations under four segments comprising postal services, courier, international and logistics and aviation. The postal services includes the provision of basic mail services for corporate and individual customers. Courier includes courier, parcel and logistics solutions by sea, air, and land to both national and international destinations. International includes the direct entry and transshipment. Logistics and aviation include cargo and ground handling, in-flight catering, freight and forwarding and air cargo transport. The first part of the ratio and analysis that we're gonna look at is the liquidity ratio. Current ratio is current asset divided by current liabilities. It indicates the percentage of annual obligations that the company can meet using current liquid assets. From 2015 to 2019, POS Malaysia shows a decline in their ability to pay debt. This ratio suggests that the liquidity fund is not prepared for a large amount of debt. Next we're gonna look at the quick acid test ratio. Acid test ratio is current asset minus inventories divided by current liabilities. The reason why inventories is excluded because when the business is in critical state, inventories is the most difficult to be converted into cash. From 2015 to 2019, acid test ratio show a decline in its liquidable asset. Next we will be focusing on the debt ratio.
What is debt ratio? Debt ratio is number of total liabilities divided by total asset. IT measure the proportion of total asset financed by the firm creditor. A higher debt ratio means a larger amount of creditor money being used in its operation. From 2015 to 2019, the debt ratio of POS Malaysia is increasing. IT maybe reflect that the company used IT to earn a higher return while taking a great risk. Next is the debt to equity ratio. Debt to equity ratio is total liabilities divided by common stock equity. It is to measure the related proportion of total liabilities to common stock equity used to finance the firm asset. From 2015 to 2019, the debt to equity ratio show an increase from 0.5 to 0.91. Which means for every hour 1 ringgit Malaysia it equally to 0.91 ringgit Malaysia the company owes to the creditor. This reflect a trade-off, either the risk will enchance a higher rate of return or not.
Times interest ratio is the earning before interest and taxes divided by interest. POS Malaysia show a sharp decline from 87.26 to 8.34. This is not good from an investor point of view because it show a higher debt but it cannot produce a high profit. Now we are going to learn about the activity ratio of POS Malaysia. The first activity ratio that we're going to see is the inventory turnover. Inventory turnover is the cost of goods sold divided by inventory. It is to measure the effectiveness of inventory management practice. In 2015 to 2019, the inventory turnover shows a higher increase from 109.5 to 184.1 in 2019. This shows that POS Malaysia is effective in managing its inventories. Average collection period is account receivable divided average sales per day. It being used to evaluate credit and collecting policies. Both 2015 and 2016 has the shortest average collection period, which is 88 days, where in 2017 it is the longest period for average collection period, which 136 days. Average payment period is measurement on how the company pay back the account payable within a period. How to find average payment period? We need to find account payable and divide by average purchase per day. From the graph we can see that in year of 2017 the number of days for account payable to be is highest during 5 years period, which is 217 days. Gross profit margin is gross profit divided by sales. IT measure the percentage of each ringgit remaining after the company has paid for its cost of goods sold. Based on the graph during 5 years period, the percentage of gross profit margin increased from 12% to 19% for next 2 years. IT show and decrease from 19% to 11% in 2019. Operating profit margin is operation profit divided by sales. IT measure the percentage of each sales remaining after deducting all cost and expenses. IT represent a pure profit earned for each sales. During 5 years period, the lowest percentage of operating profit margin is shown in 2016 and the highest is in 2015. Net profit margin is the percentage of each sales remaining after deducting all types of cost and expenses. The formula for the profit margin is earning available for common stockholder divided by sales. In 5 years period, net profit margin show a significant increase from 17.97% to 51.45% in 2017. Later on it's decreased to 45.49% in 2019. Next we're going to look at earning per share. Earning per share is interest to present or prospective stockholders and management. The formula for EPS is earning available for common stockholder divided by number of shares of common stock outstanding. In the year of 2015 and 2016 both EPS is the same 50.0. Meanwhile for the rest of 3 years the EPS is also the same 130. Return on total asset is equal to total earning available for common stockholder divided by total asset. IT measure the effectiveness of management to generate profit using available asset. The return on total asset ratio show the highest projection in 2017 and the lowest is in 2016. Lastly is the return on equity measure on the earning that the company generate relatives to the equity invested. The return on equity formula is earning available for common stockholder divided by common stock equity. During 5 years period the return on equity ratio show a significant increase from 23.91% in 2015 to 62.46% in 2019. Now we will enter the last part of the ratio analysis, which is the market analysis. The first one is the price earning ratio, PE ratio. The formula is market price per share of common stock divided by earning per share. The graph shows that the price earning ratio is increasing from 0.12 in 2015 to 0.42 in 2017. Later on it started to decrease sharply to negative 0.07%. The last ratio that we are going to look at is the market book ratio. The formula for market book ratio is market price per share of common stock divided by book value per share of common stock. The market book ratio has the highest value in 2017 and the lowest value in 2015.
These are the significant events that happened during 5 years period. Recommendation for the post-Malaysia SDNBHD. Formulate a better debt recovery system and increase the inventory sales capacity. Manage the borrowing fund wisely while reducing the investment risk.
The end. Thank you for watching.